Hello, everybody, and welcome to this Saturday, June 1st, 2024 edition of the Fab Five. I'm Tom Boley, Chief Market Strategist here at earningsbeats.com, and I want to go over 5 stocks that I feel like are pretty compelling to watch or to look at, not only for what they did last week, but what they may be doing or getting ready to do in the month of June. I am in particular going to talk about 4 consumer discretionary stocks. And there's a reason for it, and I'll tell you that a little bit later in the show. But first, why don't we just go ahead and jump in to the stocks that I want you to take a look at for this week and maybe even going forward a little bit longer than a week. First stock I have for you today is Gap Inc. All 5 of these companies, by the way, reported earnings last week, and some of their earnings were exceptional, and we saw some really nice market reaction to these stocks. And I think could be starting more of a significant move to the upside because many consumer discretionary names have not really been performing well in the market. But again, like I said, there are 4 of them here that I want to go over with you today, and then I'll give you a 5th stock to watch for as well. Anyhow, the gap, you can see big gap up. Look at the volume. That was one thing I really wanted to point out was the huge volume that came with earnings. Not only did we get a gap up and an initial pullback to the downside, but we saw a significant rally into the close, clearing the March high. So we have a breakout on Gap shares, and we did it on incredibly strong volume. It was the second heaviest volume of the year, and you can see what happened after the first. We were going up, we gapped up, a little continuation gap, and look what happened after that. We continued pushing pretty heavily to the upside. So I don't know if we'll get that kind of move or not, but I do think that this is a new set of buyers coming in on this continuation move and on this latest breakout. So GPS looking good. The AD line jumped at the end of last week, not only from earnings, but also the 2 days prior to earnings. Really nice increase in volume those 2 days, finishing near the highs. So the AD line was already starting to turn up, and then with earnings, made that jump close to a breakout. I think that breakout in the AD line is coming. On a relative basis, you can see that Gap actually moved to a new 52-week high relative to its apparel retailers' peers. So all in all, I see really good stuff here on Gap, and I expect GPS in time to move higher. I did put in here a couple of support lines. If we do see short-term weakness, I think you've got great support at the top of Gap support, which is at 27. And then intraday, we had gone down the selling, early in the day, went down to about 25, and then we came rallying back off of that. So that's where buyers stepped in and said, no more downside. So I would be looking at those 2 levels, particularly $27 as key support. Second stock, this is another apparel retailer. This is Abercrombie Fitch. When you look at the stock, A&F, big move to the upside with earnings. Again, check out the volume, the fact that we closed up near the high of the day. That tells me there was almost insatiable demand to the upside. AD line, very strong. It's been strong for quite a while. The relative strength, been strong for quite a while. Now we get the big volume and an extenuation of that move to the upside. I think any selling here over the next couple of days could produce a really nice reward to risk setup. A&F got up almost to $200 on Wednesday. Came back down Thursday and Friday. If we were to make our way back down to about the 155 level near the opening price on on A&F on Wednesday, I think that would be a great entry. You've also got the rising 20-day moving average, which currently is at 148.20, but it is rising. So that'll quickly be up into the 150s. And then I put in another support area that we had a double top at 140. And when we cleared that back just a week or 2 ago, kind of left that in the dust, and we haven't gone back to test that yet. So that's the key range for me is between 140 and 155, although I'd be a happy buyer right around the 155 level, at least starting to build a partial position. But again, the volume, AD line, relative strength, everything looks good here. And consumer discretionary, I'm going to show you in just a bit, does like the month of June, more so than many of its aggressive sector counterparts. Let's see, next chart. CAVA. This is one that we actually mentioned in our trading room last Wednesday. I've gotten feedback from members who actually got into the stock, did extremely well with it. It had pulled back. They came out with nice earnings. They had pulled back, went below the 20-day moving average. But we have a stock that's got an AD line, which has been consistently moving higher. That tells us that usually the end of the day action is pretty strong to get us into the upper half of a trading range, of that day's trading range. And so the fact that we had good numbers, we had gone down just slightly below that 20-day moving average. What we were waiting for was just a slight turn back to the upside on an intraday basis. Once we got that, CAVA just took off. Later that day was trading at $87, $88. After, when we mentioned it, it was between $76 and $77 at about 10:15 a.m. or it was in the 10 o'clock hour Eastern time during our live trading room. So anyone who jumped in at that point made a boatload to the upside. Anyhow, great AD line, nice uptrend. Again, we have a stock that is in the discretionary area. Restaurants and bars. Restaurants and bars had been weak, but we started to see strength, and you have a leader here. So if all of a sudden we get discretionary stocks that are seeing more and more money rotating in, and we start to see relative strength from areas like restaurants, a stock like CAVA could do extremely well as a leader in that area. So watch for that. Big volume coming in, just like the other two. Very heavy volume to support this move to the upside. And look at that AD line just continuing to push to the upside. How about stock number 4? This is the last of the discretionary stocks. This is a specialty retailer, Chewy, CHWY. Now, this one is one that, honestly, going into earnings, I wouldn't have given this a second look. I would not have been expecting much. AD line was going down. Relative strength had been very poor. There was nothing really to like. So I'm not looking at this saying, oh, man, you could have gotten in, right before earnings and made this huge run. I wouldn't have done that myself. But sometimes when stocks come out with an earnings report, that can be the catalyst to change the character of a chart from a downtrending chart to an uptrending chart. And with CHWY, I think there's a possibility we're in the process of seeing that. Big gap up. Look at the volume. It dwarfs everything on the chart going back to last year. Obviously, a lot of folks jumping in at the opening price, even though it gapped up over $2, continued to drive it higher. By Wednesday or by Thursday, it was up to 22.5 from where it had closed prior to earnings below 17, and then started pulling back a little bit. Couple things I want to see. Number one, I want to see on a relative basis, I want to see Chewy relative to its specialty retailers continue to move higher. We flattened out after we got that gap up. I want to see a resumption of that move to the upside. Also, over the last month, we've seen specialty retail starting to show some strength relative to the S&P. So if money continues to rotate away from technology and into areas like specialty retailers, you could see a stock like Chewy, which had been an underperformer for a long time, all of a sudden become a much better relative performer and start leading in this group. Finally, the AD line, which jumped last week with that strong move, I'd like to see that break out above this double top. So that double top takes us back about 4.5 months. I want to clear it and have an uptrend in the AD line, have an uptrend in relative strength. And I think this is a stock that could easily go back up, challenge that 25 level from December. If not, go right through it to the upside. So that's stock number 4. The 5th stock I want to show you, this one is actually outside of consumer discretionary, moving into the technology area, but into a more defensive area within technology, or more value oriented, which is telecom equipment. Obviously, there are some growers in the group, but they tend to be, at least this group tends to be slower moving than some of the other groups within technology. But the huge move, cannot deny it. You can see that, again, massive volume, biggest volume of the year, accompanying this breakout to the upside. And it was buying all day long. And with this kind of volume, 2 days in a row closing near the high of the day, you can see the AD line beginning to soar back to the upside. So I see this as a lot of accumulation. Any kind of a pullback first to test support would be right around the 24 area. And then, of course, if it were to go all the way back down to where we opened, I don't think it goes down that far. There's another area right in here, probably around 23. My guess is 23, 24 is where we see probably if we drop, that's probably about as far as I see it dropping. But I went ahead and put this support level in at 21.5 as well. Those would be the areas to watch on any kind of a pullback. But this is a stock because it is it's in an area that's a little bit more value oriented. If we see that rotation during the month of June, I think we could see some additional gains in a stock like CRDO. This is Credo Technology Group. All right, so why am I focusing so much on consumer discretionary? Well, throughout this secular bull market advance, I'm talking about since the time we broke out above the 2007 top on the S&P 500, that occurred on April 10th, 2013, which was about 12 years ago. I ran the seasonality chart, XLY, relative to the S&P 500 for the last 12 years. A couple things stands out. First of all, you can see that the XLY outperforms the S&P 500 roughly during about 3 out of every 4 years throughout this period. So it's been a very strong tendency for the XLY, not just to maybe go up, but to outperform the S&P 500. That's what this comparison right here is doing. This is telling us that the XLY has outperformed the S&P 500 during the month of June by about 3/4 of the time, or during over 3/4 of the time. And if you look down here at the bottom, I'll zero in here a little bit so you can get a better look. June averages, the XLY averages outperforming the S&P 500 during June by an average of 1.1%, which you might not think is a lot, but I want to show you the other groups because the XLY stands out on its own among aggressive groups during June. So if we go back and we look at the technology group, XLK versus the S&P, in June, only goes up 27% of the time. That's how often the XLK outperforms in June, 27% of Junes. And if you look down here, the average outperformance, 0.1%, a full percentage point behind what we saw with the XLY. How about communication services? Let's come over 12 years and let's zero in. There's your June number right here, minus 0.1, and only outperforming 36% of Junes during the secular bull market advance. How about industrials? Another aggressive area. Going back to 12 years, right here, we've got June averaging underperforming by 0.2%. It goes up roughly outperforms roughly half the time, but has a negative relative return in June. And then finally, financials, the other aggressive group. Go back 12 years, zero in on June, 36% of the time, and minus 0.7 underperformance. That's an average of all Junes going back the last 12 years. So second place isn't close. Consumer discretionary is where the S&P 500, where we typically see money rotating. If we're talking about aggressive groups, that's where the money tends to go. And that's why I focused on 4 of the 5 stocks today in that consumer discretionary area. It's a great way to use, the Stock Charts website and the tools that they have combined with our research that we do to find stocks that have a better chance of outperforming. No guarantees. That's not what nobody can guarantee anything in the stock market, but it does improve our reward to risk opportunities. And I think the percentage of success or successful trades that maybe we should be expecting. So anyway, look out for those 4 discretionary stocks along with CRDO. I think those are 5 fab stocks that you'll want to watch in June. Last thing I want to mention is we are having a spring special over at Earnings Beats. So if you go to our website, earningsbeats.com, you can scroll down, click on that link. It is absolutely the best deal of the year. Check it out because it expires on Sunday, June 2nd at midnight. So this is your opportunity to get in, focus on the things that we do. I think we're going to help you in terms of market guidance and certainly in terms of education and research. So check us out. We'd love to have you. If you just want to try to start getting used to who we are, and maybe you're new to Earnings Beats, you're new to me, Scroll down a little bit further. We have a free Earnings Beats Digest, comes out Monday, Wednesday, Friday. Think of it kind of like chart of the day. It's a paragraph. It's 2 paragraphs in a chart that come out Monday, Wednesday, Friday mornings. Name and an email address, all it takes. No credit card required. You can unsubscribe at any time. I think you'll learn a lot and perhaps find some great trading opportunities by following our EB Digest. Join the tens of thousands of folks that already follow us and know all about the way we approach the market. So check that out. Anyhow, that's it for me. If you like the video, click the button, like it, and also subscribe to our channel. Really help us in building our YouTube community here for Earnings Beats. And it would help us even if you're not a member. It's a non-financial way to help support us here. Have a great day, everybody. Happy trading.